We do think we're in a bottoming process. I know it's frustrating, and I've been in many of these markets. These are bear markets. Anything down more than 20% is a bear market. And at the turning points, it just seems so frustrating. But stick with me as I'm going through the usual drill here, and I want to give you a sense of why we think we're bottoming, and what the tug of war is out there, and how the evidence is piling up that we are probably moving into a deflationary environment. We're getting real numbers now. This is not just a hypothesis. If we're right, then the downturn during the first half of the year, 2 quarters of negative real GDP growth, that downturn might be worse than has been reported. So I'll get into that in a little bit. And it means that the inflationary pressures that are concerning the Fed are probably going to unwind now very quickly. It is true, the last year, against our expectations, has been a very difficult one when it comes to inflation. I never dreamed, given all the new technologies in place to take care of these things, that the supply chain issues that started in April of 2020 would extend for more than 2 years. It's still pretty shocking to me. We do believe those are loosening up now. We're getting all kinds of reports that that is the case. And we also did not predict, no one did, the Russian invasion of Ukraine, which has sent food and energy prices soaring, which is a really cruel tax on the consumers around the world. So I've also not been in a period where fiscal and monetary policy during a recession have actually tightened up. Typically, fiscal and monetary policy are contracyclical. In other words, when the chips are down, the economy is in recession, usually fiscal stimulus and monetary stimulus follow pretty quickly. And instead, what we're getting now is the opposite: fiscal policy tightening, including the Inflation Reduction Act, and monetary policy tightening, and tightening aggressively. Chairman Powell gave his annual presentation at Jackson Hole, or gave the Fed's annual presentation. And we read line by line what he said, and it was very interesting. He invoked the name of Volcker, former Federal Reserve Chairman Volcker, who really combated the inflation of the late 70s and early 80s. He invoked his name twice, but he also hinted by using the phrase "keep at it" or "keeping at it" twice. So that was really a reference to the late 70s, early 80s. And I really do believe that the Fed believes that we have a problem that might be that significant. If they didn't believe it, they wouldn't be acting this quickly. And I think they're awfully afraid of ruining their own legacies. They do not want to be known as the Federal Reserve members who presided over another big wave of inflation. And as we've been saying for quite some time, we think this inflation is more associated with the shock of COVID and the rebound and all of the distortions that took place because of it. And we're getting more and more evidence about that. Now, one of the things that concerns us is because they are so fearful, the Fed members have taken the Fed funds rate up from 25 basis points, so 0.25%, to 250 basis points, 2.5%, in the span of a half year. That's a tenfold increase. Now, we were in a period, especially after 08, 09, where the Fed was, basically laying low and just letting the economy heal. And so we had this extended period of very low interest rates, which started to change in 2017-18. And then they had to rein it back in because at the end of 2018, the economy looked like it was going to fall apart. And then, of course, in 2020, we had COVID. Nonetheless, for most of the last decade, very low interest rates, very little movement in interest rates, and now all of a sudden, a tenfold increase in short-term interest rates. Many people are using the level of interest rates to suggest that this is not really tight monetary policy. It's only 2.5% on the interest rate. But I really believe that change has been a tremendous shock to our system and certainly to housing. We're seeing statistics, and I'll go into them in a moment, all over the place, that housing is in a recession. And I do believe we're seeing evidence that prices are going to follow. So we're concerned that the Fed's overdoing it, and that in invoking Volcker's name twice, outright and then indirectly twice, that Chairman Powell was basically going to say, we're keeping at it, and we almost don't care what happens to the economy. And in the statement, it was very interesting. There was no focus on real economic activity. The only focus was on inflation. So that was a clear message. We don't care. We just want 2% inflation. Now, the reason this is so important from an investor's point of view is if you look at valuation, so PE ratios in the 70s and early 80s, I think they bottomed out somewhere between the 6 and 7 times range. So 6 or 7 times earnings. And I believe that was in 1982. And that was because inflation had been ingrained, and the discount rates, we were at a double-digit interest rate, so valuations should have been that low. Now, many people believe, and certainly the bears do, that we are back in a 70s environment. And that is why they're very negative on the equity market. Because today, the PE ratio of the S&P for S&P earnings this year, and I actually think that's too aggressive, but that's close to the consensus estimate, the S&P 500 is selling closer to 20 times. So many people who are seeing another big drop in the market are focused on valuation and that metric. And yet the bond market does not agree with this at all. In the 70s, bond yields just kept going up inexorably. And that is not happening now. If you look at the 10-year Treasury bond yield, it is having trouble getting above and then staying above 3%. We dropped to 2.5%, for example, in August. And now with the Fed's latest rhetoric, and especially Chairman Powell's Jackson Hole presentation, the bond market has back up into the threes. But we don't think it's going to stay there. And I think that most of the people who believe we're going back into a 70s environment think that interest rates are going to double and then double again from there. If they do not, if these interest rates do not continue to move up, and we do not think they will, the long-term Treasury rate, I'm not talking about the short-term, that's more governed by the Fed policy directly. The long-term inflation rate is more focused on the next 10 years growth and inflation outlook. And so far it's saying that anyone thinking we're back in the 70s is wrong. And I think a lot of price indicators are beginning to corroborate that. The reason we worry about the Fed making a mistake is it seems to be focused on lagging indicators. Now, employment is one, but I think in the Jackson Hole speech that basically Chairman Powell said he didn't really care what happened to the real economy, and that would be employment. But the PCE deflator, so the PCE deflator that the Fed uses is the core PCE deflator, taking out food and energy, which are sometimes held hostage to supply shocks, like we have seen. And I'll get into where that metric is, but it peaked in, I believe, February, and has been coming down little by little since then. We'll get into that. But it is a lagging indicator, and we're down to 4.6 just to get to that punchline. And I think if we've just started to see declining prices hit the PCE deflator. It won't be long until we get to 2% if we're right about the massive inventory overhang, not only in the United States, but around the world, and the kind of price cutting that will take place to clear shelves and clear pipelines. We're also seeing a lot of commodity prices already reflecting either that expectation or that reality. So we wish the Fed would focus on some of these leading indicators of inflation, because by jacking up interest rates from here, they're going to make this recession worse. But we also believe that these declines in commodity prices are going to get into the broader-based price indicators closer to the consumer. And that if that happens and the broad-based price cutting becomes headline news, the Fed probably won't need to see the whites of the eyes of 2% inflation. We do think we're in a bottoming phase here because we think we're going to see a lot of deflationary signals that will, at some point, get the Fed to talk about them. It doesn't want to talk too soon. It doesn't want to give anybody any indication that it's anywhere near pivoting. It wants to sound very hawkish, wants everyone to believe that they're going to be as tough as Volcker was in order to get to 2% faster than would otherwise be the case. You know, it could be a lot less than 3% if some of these big retailers start slashing, they need to, prices in order to clear the shelves and put in holiday merchandise. So we'll see in the next few months. And I think that the kind of bull market that is going to come out of this is one that investors dreamed of in the late 90s.